About a month and a half ago, I did a trade known as a 112 in Main Street Capital, ticker symbol MAN. It then dropped 13% over the next couple of days. In this video, I'm going to show you exactly how I set up my ratio trades like a 112, and then I'm going to show you why this trade, even though it went down so fast, actually ended up being a huge win for me. I'm always looking for setups where I'd be happy to own a stock even if it kept dropping in price, and Main was a good example of that. It had just dropped 10% before I did this trade, but I believe that from a technical standpoint, it was probably going to drop some more. And that's what led me to do a 112, or as you're gonna see, it was actually a 113. And I'll tell you what a 113 is in just a minute. But after I show you the trade I did, I'm then going to show you what happened and why it turned out to be such a good trade for me. That way you can decide if you want to do a similar type of trade. I opened this 113 ratio trade in Main, even though it had just dropped 10%. And what was worse, it had just broken through support. Now I believe from a technical standpoint, it still had room to come down. But then it did something that really surprised me. And on expiration day, well, it did something really wild, something that almost never happens. But here's the crazy part. Even though Main dropped another 12% after I entered this trade, the position ended up paying me max profit. And the biggest winner, it wasn't the short put options that I sold, and it wasn't an awesome assignment price. It was something completely different. In just a minute, I'm going to answer the question, how do you structure a 112, or in this case, a 113, when you think the stock might still drop more? But now let me show you why I thought this Main stock had the perfect setup for a 112 or a 113. First, notice that Main Street Capital had just dropped almost 10% over the previous several weeks. And it also just broke through technical support, as you see on this daily chart. Notice it broke through the support that it found back in here in August at around $63 per share, and then found support around $62 per share. But then the day before it had tested that support, the day I did this trade, it broke through that support as well. As a result, from a technical standpoint, I thought it still looked weak. I thought it'd probably come down more in price. The other thing I thought about is, where would I be happy to own some shares of Main Street Capital? Now, I already own some in my outright stock ownership account, but in my main option trading account, where would I be comfortable owning shares of this dividend paying stock? I decided that around $50 per share, I'd be happy to own some shares of Main Street Capital. I thought I'd be trading at a discount at that price, and I'd be happy to collect its nice high dividend. However, I would not be happy to have to buy it around $60 per share. With that $49.70 put option strike price, that became my anchor point. That was an important level for me. And one reason it was important because that's where I generated the income to buy my bearish put debit spread. You see, that was my risk. If all else failed and Main Street Capital just plummeted way down in price, I'd have to buy 3 contracts worth or 300 shares worth of Main Street Capital at $49.70 per share, and I would be happy to do that. In just a minute, I'm going to answer the question, what actually happened when Main Street Capital dropped right after I did this trade, and why did it end up being such a big, easy win, even though it experienced a sharp price drop? But now let me show you how you should structure your 112s, or in this case, a 113, when you think the stock might still drop in price. Let me first show you the trade I did, then I'll talk to this position with you on the charts and why I chose these strike prices. First, the trade I did. Because I was still bearish on Main Street Capital, I bought the November 21st $59.70 put option. That was the highest strike put option that I did in this trade. And notice that I bought one of them. Now, if I just bought that put option, it would have cost me $1.64 per share, as you see up here. But if you know me, you know I don't like to enter trades for net debit if at all possible. I like to get paid to enter trades. So in order to do that, I sold 2 different put options against the one I just bought. I sold the same expiration day, November 21st, $54.70 put option. That put option strike price is $5 lower than the put option that I owned. As you see here, I got 69 cents per share for selling that put option. So I still would have been out of pocket about 95 cents per share for this position. Well, I didn't want that. I wanted to enter it for a credit. So I looked at what strike price I'd be comfortable owning Main Street Capital at if worst came to worst, and I decided that $49.70 per share was that price. So in order to enter this position for a credit, I sold 3 contracts of those $49.70 put options that expire on that same expiration day, November 21st. As a result, I entered this position for a net credit of $10 minus commission. Now let me show you what that looked like on the chart. So here you see the daily chart of Main Street Capital up to the day I did this trade. Notice that it recently found resistance around $68 per share, and it had come down, as I mentioned earlier, and broken through support. It was now approaching this red 200 moving average on this daily chart, as well as some potential support right here around this $59 area. But overall, we're making new lower highs and lower lows, as you see here. Now, I thought that Main Street Capital had the potential, if it really started heading down hard, to probably retest its lows from back in here in April, which would be around $47 per share. I didn't think it was really likely, especially in the next month or so, but I thought it was a possibility. So I wanted to get as close to that as possible, and that's why I decided to sell that $59.70 put option. That to me would be close enough, and I feel like it'd be a good deal to buy Main Street Capital at that price. So here we sit. I own the $59.70 put option. I've sold the $54 put option. So if it ends up right around that $54.70 strike price, I get max profit of $5 because remember, I got $10 to enter this trade. So $5 times 100 shares, that'd be a $500 win. Now, if it kept going, I still get to keep my $500 profit here, but I have to look at possibly buying some shares at $49.70 if I didn't do anything about it. Now, if it kept going down, I still get my $500 profit from my put debit spread, but I'd be faced with the possibility of possibly having to buy some shares at $49.70 per share if I didn't do anything about it. All right, so here's my structure. I bought the highest strike price put option, the $59.70 put. I sold the $54.70 put option, $5 below that. This gives me a bearish put debit spread. That spread will like it if the stock comes down. Then I sold additional put options at a price I'd love to own Main Street Capital at. In this case, it was $49.70 per share. And if I was to sign all three contracts, my position sizing would still be well within my limits for myself. This did two things for me. It gave me a net $10 credit when I opened the position, and it gave me the ability to make a really nice profit of $500 if everything went my way. In just a minute, I'm going to answer the question, how do you know when it's best to just sell some put options or do a 112 or 113 trade like I did here? Let me show you what actually happened when Main Street Capital dropped right after I did this trade. And then let me show you why it ended up being such a big, easy win for me. Remember, the yellow arrow is the day I entered this 113 trade. Notice what happened immediately after I did this trade. Main Street Capital had been trading for around $63 per share, and it dropped in just a matter of just a couple of days all the way down to $55 per share. That was an over 10% drop in just a couple days. As I zoom in here, let's talk about what that meant to my position. So I own this $59.70 strike price put option, and it landed right at my short put option strike price of just above $55 per share. My long $59.70 put option, it was very happy with this drop. The short one, it had gained some value, but was still out of the money. So theoretically, if it expired right there, that option would be worthless. I have a nice gain on my $60 put option. Remember, I also sold all those additional put options down at $49.70 per share. Those are still well out of danger. And I'm still good with that price. I'd be happy to own 300 shares of it at that price if it came to that. So in reality, although it dropped really fast right after I did this trade, I was very happy with the position. I structured it in a way that I was going to win no matter what. And I realized this possible $5 per share or $500 profit, it was actually a reality now. That failure of technical support totally went my way. It was a good read, and I had the potential to make some really nice profit on this position. Now, before I answer the question, how do you know it's better to sell a 112 or a 113 instead of just selling put options? Let me show you how this trade closed out. Notice that after that big drop in price, it then went up about 5% or so, and it just kind of traded sideways for about the next month and a half. And here at the yellow arrow, that's the day this position expired, November 21st. That's the day I closed this trade out. Now, this very seldom happens, but notice on the day of expiration, which was November 21st, notice where Main Street Capital traded down to, right at our short put option strike price. So our $59.70 put option was way deep in the money, and it was right at the strike price of the put option I sold. That was the perfect spot. As a result, and as you see here, on the 21st of November, we closed this position out for a nice credit of $4.40 per share, or $440. So we got $10 when we entered it, got another $440 whenever we closed out, a nice profit of $450. So how do you know if you should consider doing a 112 or 113 ratio kind of trade instead of just selling put options? Well, first of all, no matter what, make sure to only sell put options at a strike price you'd be happy to own the shares at. For me, that strike price was $49.70 per share. I've been really happy to own some Main Street Capital at that price. So that'll be your income portion of the trade. But if you think a stock might continue going down in price, instead of just selling those put options at that strike price you'd be happy to own shares at, consider adding in a bearish put debit spread. That's especially the case if the stock has just recently broke through support. If you see you might be able to set yourself up to benefit if the stock keeps coming down in price by doing a put debit spread also, you can do it for free, then why not consider doing a 112 or 113? Just make sure you understand your risk before placing any trade. Never risk what you don't understand you're risking. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. A ratio type of trade like what I shared in this video, 112 or 113, can be a powerful tool to have in your tool bag. But before you trade in it, you want to completely understand the risk and the rewards that a position like this can produce. In the video with the link above, I share some vital tips you must know before trading a ratio spread like a 1-1-2. So check that video out. It's entitled Do Not Trade a 1-1-2 Strategy Until You Watch This Video. Until next time, happy investing, and we'll see you again soon.